Hi, everybody. Dan Weiskopf here. Welcome to today's happy hour. I'm the ETF professor, also lead ETF strategist for the ETF think tank, and also portfolio manager with Mike Venuto with the blockchain ETF. Today's show with David Bazansky and Christopher Leonard will be very exciting. I'll hand it off to David to get started here.
How's it going, everyone? David Chikansky here, portfolio manager within the Title Financial Group. Very excited to have Christopher Leonard on to talk all things Federal Reserve, a distinguished investigative journalist and author of The Lords of Easy Money. Christopher, I'll pass it right over to you. If you can introduce yourself, talk a little bit about what brought you here today and, the inspiration behind the book, and any relevant opening thoughts for today's conversation.
You bet. Thank you. And thank you so much for having me. It's great to be here. In short, I'm an investigative reporter and an author, and I focus on business. And sometime around 2016, 2017, I came to really understand quantitative easing for the first time. And it just occurred to me that what the Federal Reserve had been doing since 2010 is one of the most important business stories of our time. The Fed was engaged in really unprecedented and risky experiments in easy money policies. The way I try to shorthand it is the Fed printed 350 years worth of money in about 4.5 years between 2008 and 2014. And of course, they printed much more when COVID hit. And so with the book, I'm just trying to walk through how the Fed works, what they were doing in the 2010s, how it affected our economy, and how decisions get made in this pretty opaque institution.
I love how you say it's opaque, because isn't it supposed to be pretty transparent?
God, I'm stammering. So, yeah, it's interesting. Ben Bernanke, who's a main figure in all of this, he started doing the Fed press conferences around, I think, 2009 or 2010. And we do see Chairman J. Powell out in public giving these press conferences. But it's really important to remember, I think, that the Fed's top committee, the FOMC, which has 12 voting members, they do meet in secret, okay? And they release the minutes of their meeting after a delay of some months, and they release the transcripts of what they say after a delay of 5 years. But, when you really get into the thick of it, a lot of these decisions are made behind closed doors. A lot of it's happening between Fed governors in DC before these meetings even happen. So yeah, I think it's an opaque institution in its decision-making that puts out a deluge of information into the public in terms of its reports or press conferences. But the decision-making is behind closed doors.
I think it's funny because in today's world where information is traveling more and more and everyone wants a platform with a microphone, you're seeing more and more Fed governors give their own speeches and their own thoughts on the market. But you're right, while there's more news and information to go through from these guys, it's almost just noise because all the real decisions are still made behind closed doors and they all have their own reasons for their perspectives, and it feels like it's just a whole lot more noise, and everyone in the quant world is trying to kind of decipher all these weird little signals, and sometimes it's just like a whole lot of noise for no real actual value, because as you said, a lot of it is just done behind closed doors. And we were talking pre-show about the schedule of Fed meetings this year and kind of when the Fed could actually raise or cut rates without actually appearing political, which we had discussed as pretty much just July and December. As of today, we're now expecting just one rate cut this year, and we're talking December. So what are your thoughts on that? We went from a 7 rate cut year down to a 1 rate cut expectation so far. And we're only, 3.5 months in.
Yeah. If I could, and again, to speak of the opacity, nobody has any real clear idea of what Jay Powell is thinking, the chairman of the Fed. And the chairman has a huge role and a huge influence. Just to underscore the point, there are 12 voting members on that policy committee, but 7 of them are governors. They all work in the same office, rather the same hallway of offices at the Fed Eccles building in DC. And one of the governors, Betsy Duke, told me on the record that, they meet one-on-one with each other and they know how they're going to vote before the meeting ever happens. Okay. So you're asking about rate cuts this year. And listen, the presidential election is really important, and I don't want to underplay that. But I really do think that the key thing is this tension between that Jay Powell faces, this tension between keeping rates so high that it creates more banking crises or even more damage to the commercial real estate market or a recession, versus the risk that they cut rates too quickly to keep inflation falling. And to me, the biggest political issue is that the Powell Fed has tied the central bank's credibility to getting inflation down to 2%. And if they back off that promise, and if they are seen to be cutting rates before they really have inflation, at least on a firm track to get to 2%, they're going to lose credibility. And that credibility itself is a really key part of keeping inflation low. I mean, a lot of these economists think that one of the reasons we haven't had higher price inflation is that markets have this sort of built-in expectation that the Fed will step in and control inflation when they have to, and that's what's on the line right now.
You said something that I kind of struggle with, that at some point we have to have a recession, right? I mean, a little bit of a recession is healthy for the economy. A bad recession is when it's, dragged out for a long period of time. We always seem like we're fearing that recession and Powell's going to rescue us from that. But isn't it kind of inevitable that we're going to have a recession at some point?
Well, it's absolutely inevitable that there will be a recession at some point, of course. And I mean, I don't want to, the necessity or not of having a recession, we could just debate the whole show for sure. But to me, the big dynamic here is the Fed kept money ultra easy for over 10 years. I mean, interest rate, short-term rates pegged at 0 for basically a decade. Trillions of dollars of newly printed money through quantitative easing put into the banking system. And to me, the real fear is how can they hike rates and lower their balance sheet or do quantitative tightening without creating a major financial crisis, let alone a recession. And so, the bind is, again, they need to show that they can fight inflation without having the whole system short circuit, because it's a system that's gotten so used to low rates and quantitative easing for so long. And as a lot of smart people expected a recession, particularly in 2023, and it hasn't materialized. And I mean, inshallah, that's wonderful. If we can get through this whole thing and get inflation down to 2% without a recession, I think that would, as a rule, be good. The problem is, inflation can easily get out of hand and gain strength.
Yeah, I mean, something we're seeing as of late, and this is no longer just a phenomenon in the US, this is something that's like playing out in the majority of the developed world, is we're like, okay, rates are up. When is this thing going to cool off? Let's price in all these rate cuts. And one by one, the developed world has unwound these rate cut expectations. And one going thesis is, when you hike rates to stop a corporate debt bubble, it slows down the economy. But when you hike rates to try to stop a government debt bubble, it actually might do the exact opposite. So what are your thoughts on that? Is this actually stimulative to some parts of the economy right now? And are rates actually holding these numbers up? A lot of the higher inflation prints we saw were really just backward-looking numbers that are tied to inflation, like auto payments and things of that sort. But has the reverse occurred in the developed world where like all the debt is on the government's balance sheet, and this is actually now inflationary for the economy and keeping this economy afloat right now?
I'm afraid my answer is going to be so unsatisfying because to be honest, I really don't know. And the only point I can firmly hold on to as a reporter is it's probably going to take us 10 years to figure out, for example, why price inflation jumped from almost non-existent in 2020. And I mean, as you know, price inflation had been stagnant for years in spite of this incredible money printing. And then it explodes up to 9%. It seems almost inarguable that the supply chain stuff had a lot to do with that. But in terms of what's happening right now and these dynamics that you just pointed out, I have no clue. I'll just be honest. And I don't think we're really going to know until we're 5 years out of this thing. But one of the points I keep trying to make in the book, and again, this is about Fed policy for your average citizen kind of thing, is how I wrote it. But what's so critical is that these Fed policies of the 2010s have put us into profoundly uncharted waters. You know, when you talk about so much of this debt being on the government books, as you know, a huge portion of this money printing was executed by purchasing Treasury bonds, government debt, and putting it onto the Fed's balance sheet. And particularly during COVID, the Fed was one of the largest purchasers of government debt in the world. They were buying a majority of government debt issued every month, and now they're out of that market. And so the actual potentiality that these rate hikes could be inflationary because so much of the debt is on the government's balance sheet is one of these crazy dynamics that we're dealing with in 2024 that people never would have even conceived of in 2009. That's all I can say.
In your book, do you cover some of the past chairmans? I mean, when you look at Greenspan, you look at Volcker, and you look at Bernanke as an example. They had different conditions during their reigns, right? Do you have any thoughts on comparing, contrasting the different chairmans?
Absolutely. And the one surprisingly I'd really like to start with that we kind of mentioned before we started is Arthur Burns. Okay. He's someone we don't talk about a lot, but he's kind of widely viewed in Fed circles as one of the worst chairmen ever. And he was over the Fed in the late 60s. And Arthur Burns, and this is based on the Fed's own research, Arthur Burns made the mistake of hiking rates to fight inflation. But then every time inflation started to fall, the Fed too quickly lowered rates again because they wanted the job market to improve and they wanted to stoke employment. And what that did over time was that inflation would go down, they would cut rates, and then inflation would come back more robust than it was before in this cycle that led up to, by the late 70s, we had inflation in double digits. And so, I mean, one thing I can say with total certainty is that Jay Powell has studied this and is determined not to be the Arthur Burns of 2024. The dude is going to hold rates high until it is clear they have brought inflation where they want it. In terms of the other chairmen, actually, except for Yellen, I mean, it's fascinating. You're right, they've had different conditions. I guess the one point I do want to make is how consequential Bernanke was as a Fed chairman. I mean, being on the helm during the financial crisis, but then critically, what they decided to do after the crisis, starting in 2010, when they did quantitative easing, and totally transformed financial markets. That was a huge decision that they made at a moment when we weren't necessarily in crisis. And I really do think after Bernanke, you go to Yellen, you go to Powell, and everybody is really living in the shadow of these incredibly ambitious decisions that Bernanke made starting in 2010.
I remember listening to Greenspan and often trying to figure out what he was really trying to say when he was speaking. Do you remember like some of those meetings where he would come up in front of the Congress and trying to communicate, and nobody understood what he was saying?
There's I think a whole chapter in the book called Fed Speak, and it's been a little while. And you know, Greenspan famously said, if you can understand what I'm saying, I'm doing it wrong. And there were a lot of reasons for that because, the markets hang on every utterance of the Fed chairperson, and you don't want to paint yourself into a corner. But as a normal citizen reporter kind of guy, I actually think Greenspan did a disservice to us by over his tenure with his oracular pronouncements that were impossible to understand. And I quote a paragraph of his testimony in the book, and you're just dizzy by the end of it. But he created this picture that what the Fed is doing is rocket science or nuclear physics, that it's this incredibly complicated world that mere mortals cannot understand. And it kind of removed Fed policy from retail politics, if you will. It kind of created this picture in everybody like, oh, these super genius PhD economists are dealing with stuff I couldn't even imagine, when in fact that's really deceptive. It's complicated. Sure, it's complicated, to get down into the mechanics of this stuff, but it's not rocket science. And the Fed is doing public policy that creates winners and losers. And I think that explaining that in plain English is actually really important. And I got to give credit to Powell. He's a lot less Greenspanian, if you will. I mean, he does speak English, and he holds his cards close to his vest, but explains what he's doing, like particularly that Jackson Hole speech in August of 2020. Gosh, I'm getting my years confused here. I think it was 23. Remember when he said we're keeping rates high and there's going to be pain? I mean, it sent shockwaves out through the market. I'm going to say that was 22 August, and that was really clear. And so I think he's trying to kind of move away from that Fed speak tradition of Greenspan and speak to the markets more clearly.
So if we don't have a recession, do you think he'll ever run for president?
Powell?
Just trying to get a fun quote out of you.
Look, impossible for me to imagine. I mean, Powell, the first chapter where I talk about him is called The Fixer. And that's how I think of him. Have you seen Pulp Fiction with Quentin Tarantino?
Yes.
He's the Harvey Keitel character. He's Mr. Wolf. He shows up and he solves problems. I mean, he spent his whole career at the nexus of Wall Street and the U.S. Department of Treasury, private equity funds, and I think he's much more of a backroom guy who's a lot less comfortable doing front-facing political type events. And it is unimaginable to me that he would run for public office. Honestly, it's not that he's not charismatic. He's charismatic one-on-one, but I can't see him getting into the circus of politics.
Well, the circus of politics, we shouldn't get too far into the politics, but given who are running for president, it would be an interesting contrast, is my point, I guess.
Yeah, maybe there's a market for that. I can't tell what's going on anymore. I mean, maybe people, if they want the steady hand on the tiller.
Yeah. And then how do you compare him to Volcker?
Oh,
A whole
wow.
different person.
Yeah. I mean, Volcker is obviously, I should have mentioned him, as you know, like as everybody knows, he's the most legendary of Fed chairmen because that he really is the person who stopped the great inflation of the 70s. I mean, the fiscal side, the White House, the Congress, they'd been doing everything to try to stop it, but he plunged the economy into a deep recession by doubling interest rates, but stopped the inflation. And interestingly, had an incredibly unhappy end at the Fed. I mean, he got pushed out. He got voted against by his own committee. He did not leave that institution in glory. It only came later as people recognized what he'd done. I truly do think Powell would want to be remembered as a Volcker figure, not in the sense that he created a massive recession, but in the sense that he did the hard thing that took long-term thinking. I have not asked Powell about this. I only got to interview Powell once or twice, and this was back in 2020. But I would bet you anything he's read Volcker's autobiography and probably has a lot of respect for Volcker's example of somebody who did the hard thing.
Please tell us more about this 2020 interview with Powell. First, can you frame this? When was this in 2020? Because pretty pivotal moment in markets. I'm just curious, like, wow, just to get a one-on-one with someone like that at that time is pretty impressive. So
it was fascinating. And interestingly, I was working on the book in early 2020 and was actually touring the New York Federal Reserve Bank because I really wanted to see the trading floors where they do quantitative easing. And I was interviewing, oh gosh, is her name Lori Logan, who ran the trading desk? It's in the book. Forgive me, it's been a few years. But I mean, I was walking around that the day in February of 2020 when the CDC conference call announced that we're going to have huge disruptions and the markets fell by like 1,000 points. And it was a pretty crazy day to be in there as that was happening. And I was interviewing Powell about his response to COVID. And by this time, all hell had broken loose, if you will. And so it was over the phone with the Fed PR person on the line as well. But, Powell is he's a fascinatingly charming guy. He's self-effacing in a way that's really sincere. Whereas I've interviewed Bernanke as well, and I don't think he's as self-effacing as Powell is. I mean, again, Powell's a real operator. And so, yeah, that was the context in which I interviewed him, was talking about their extraordinary response to the COVID epidemic. I mean, I talk about them printing 350 years worth of money between 2008 and 2014. They printed 350 years worth of money in like 3 months after COVID hit. I mean, it was an extraordinary response.
They were probably prepared to print even more money than just
Without
that.
question. Without question. They did all this crazy stuff at that time, like purchasing collateralized loan obligations directly, purchasing junk debt. They had all these really complicated structures. And this guy who helped design them in the Fed explained to me, he's like, look, we weren't doing anything sophisticated. We were looking at where the fires were and just dumping a fire hose of money on it. And I think if the problems had continued, we would see a balance sheet that could have been as high as 20 trillion. I mean, it hit 9 trillion, but they were ready to do whatever it took.
So
I mean,
how do you see the Fed coordinating with the Treasury at this point in time, given the situation with so much debt?
Oh, that's a low-key, non-controversial question. Look, honestly, I mean, we just talked about politics. Remember there was this storyline about how Donald Trump was bullying poor Jay Powell over Twitter and all that stuff. When we talk about independence of the central bank, which they say is pivotally important, to me, the real nexus that needs to be looked at is not Fed to the White House. It's with the Fed and the Treasury. I mean, that's the ball game right there, because as we've mentioned, the Fed's purchased, I mean, trillions of dollars in Treasury bills since 2010. And again, I can't overstate, during COVID, the Fed was buying a majority of the US government debt that was being issued every month for a time. And so when Jay Powell stands here and talks about tightening financial conditions to fight inflation, what he's saying is that the Fed, the central bank, is going to stop purchasing government debt. They're going to step out of the market as a buyer. And that puts enormous pressure on the Treasury market, probably the most important market on earth. And without question, it raises the cost of government borrowing. It's one of the big reasons Treasury rates have risen beyond what the Fed's doing with short-term rates. And I mean, you guys know this better than I do, but you see these stories in the Wall Street Journal talking about anemic sales of Treasury bills and shortfalls in the market for Treasury bills. That's an enormous deal. And income payments on the federal debt they are the fastest growing budget line in the federal budget. And I think they've already outpaced what we spend on defense. So this raises enormous tension as to how independent can the Fed really be? Are they really gonna, if it comes down to it, are they gonna keep shrinking their balance sheet by not purchasing government debt and keeping rates high if the interest rate on a 10-year Treasury bill hits 6 or 7%, and you're seeing more hundreds of billions of dollars of our budget going toward meeting interest rates? Look, I don't have an answer to that question, but it is the biggest pain point. It is the biggest pain point when you look at Fed independence. And sorry if I'm rambling, but to close, like, these two things have worked in concert with each other. The US government issuing debt, the Federal Reserve directly buying it, and we've become accustomed to it. And so in that way, the Fed has lost some independence. I mean, not politically, but like transactionally, like they are part of the government debt system. And so far, they have held firm, and they're continuing to shrink their balance sheet, although I think I've seen some things that they're maybe slowing that down. But it's just going to be really interesting to see if they can maintain that independence over the next 2 years.
One of the changes as of late was them essentially having expectations of it trailing off. So like there's no the expectation of like ever actually having a full unwind is almost non-existent, right? So it's just going to kind of trail off at the $7.5 trillion level, which means we all probably know at some point it's going to go above that, right? Last year was like the alphabet soup of unique ways that the Fed could pump money into the system without it actually being on their balance sheet, or not the Fed, the government. But at some point that's going to come back into highlight. And actually, 29 minutes into the show, Dan Weisskopf, I'm going to make you very proud and now relate this to Bitcoin and say that moment when the Fed actually announced that 7.5 trillion was the kind of the supposed trail off number, was really like the leg of that rally in crypto after that first pullback from the ETF launch. So I think that is something that I think the crypto world is at least for Bitcoin is very, very aware of. If you have any thoughts on that, and just like would Bitcoin have been a thing if not for quantitative easing, right? I think that's like one of the amazing anomalies to think about, is like, I don't know if it would be, right? Everyone's thought of like the US government going bankrupt. I saw a really interesting tweet earlier today that said, we at one point had like, I think 30 years ago, like 25% of our debt outstanding, we had natural gold, and now it's down to like 7 or 8%. And now we have this, as we talked about before the show, this broken Excel loop of like one government entity buying issuance for a debt from this entity, but it's really all the same balance sheet. So like, why is it really different entities? And that's where we are today. But any thoughts on did this spur this whole Bitcoin movement with this like ridiculous QE cycle we saw?
Absolutely. And I do have thoughts on that. And I'd like to start in the year 2010 when the Fed decided to do quantitative easing, which I walk through it in the book. But like in essence, that is the Fed creating dollars out of thin air and injecting them straight into the banking system. That's what QE is. And they did it to the tune of about $3.5 trillion after 2010. One point I want to make is when you go back and read the internal debates that the Fed policymakers were having in 2010, they thought they were going to totally normalize or totally unwind by like 2014 or 2015. And it's just so fascinating in terms of the policy making. They always thought we're just going to do this for a little while, then we'll be able to pull back. And so that would have had a balance sheet of $900 billion or so by 2014. In fact, it was 4.5 trillion. Now it's 7 trillion. And as you're saying, like they're saying 7 trillion might become the floor or the normal operating level going forward. Does that lead to Bitcoin? Let me say this. Obviously, we used to tie the value of our currency to gold. That ended in 1971. And the whole purpose of the gold standard was to impose discipline on money creation. but the gold standard was deemed unworkable. And then the idea was, okay, we're not going to have gold. We're going to have this committee of wise people called the FOMC, and they're going to show restraint, and they will impose discipline on our money supply. I think there's an argument to be made that that discipline went out the window in the 2010s. And I don't think it's a coincidence at all that you have this, I don't even like the term cryptocurrency. You have a digital blockchain electronic currency who has a gold standard built into it by algorithm. I think that's what's so attractive about Bitcoin is there's no committee that can say, okay, let's print 18 trillion more Bitcoin. And so the stability of that is, I think, one of the reasons why it has gained so much currency, so to speak. But like, I also just have to race in to say I'm not an expert on crypto at all. I only wrote about, government fiat currency at the Fed. But it's honestly fascinating to me that Bitcoin has kind of become, do you correct me if I'm wrong, but it's almost like a synthetic gold at this point in the role it plays. Do you think that's about right?
A lot of people would agree with that for sure.
It's fascinating.
It's a finite asset, right? That can, in theory, be used as currency almost anywhere in the world. So yeah, I think that's one of the relations. I think we're seeing a unique moment in the last couple of weeks between gold and Bitcoin. I think we just saw reports that like China was buying more gold than like ever before. The Middle East was buying a lot of gold. We actually saw gold rally in the face of outflows from gold in the ETF world, which is somewhat unique. So I think the Bitcoin maxis are waiting for that trade to roll over. But if you start hearing central banks around the world protecting or investing their balance sheet in Bitcoin, I'm not pontificating and saying it will or won't. I have no idea. I think it'd be really hard for a country like China to really do something like that once they ban mining. It seems a little counterintuitive to their messaging, but if they're going to sell our dollars, they have to buy something. So what are they going to buy? And that's the real question, right? If they're going to sell our debt, what are they going to buy? So open question for either Weisskopf or Christopher to answer there. Whoever wants to take that.
So Christopher, yeah, I mean, it's an interesting point you bring up. I totally get where you're coming from. And further to the point, I think often I'm always wondering, Christopher, what other central banks are thinking about our central bank. We can't just think about the U.S. central bank in isolation, because what they do affects so many different other countries, right? What do you think the other countries are thinking about how Powell operates and how our central bank is working, whether it's Japan or China or European?
It's amazing. I mean, I really would argue the Fed is the world's central bank because, as you know, the US dollar is the global reserve currency. It's the common language of all financial trades around the world. So when the Fed either increases or decreases the amount of dollars in the system, it affects everybody else. And so what the Fed is doing affects everybody else. I'll tell you one thing. I was being interviewed by this really smart economist in Taiwan, and I think that his view was not out of line for the developing world. He was really ticked off at the Fed because of the way that it first increased money dramatically through the policies of the 2010s, right? QE, 0% interest, and then just slammed on the brakes, hiking rates to 5% in 2022. And I mean, he was asking me, do you think the Fed is doing this on purpose on behalf of the White House to destabilize the global South and hurt its competitors like Taiwan? Which I obviously don't think is the case at all, but it just shows what do others feel about the Fed? They're like that water skier being dragged behind a speedboat, just hoping that the person knows how to steer. And I feel like there's a tremendous amount of anguish in the developing world right now because things are bad enough here in the United States as we've hiked rates. I mean, it's shockingly good right now. The world is shockingly stable for a 5% interest rate, I think, considering where the Dow Jones, I know it's down a little bit today, but it's up, you know. But that's not the case in these other countries that don't have the global reserve currency. And it's not the case for governments that have tremendous amount of dollar-denominated debt who are facing much higher interest rate payments. So I think that there's a lot of ill will in the global South toward the Fed right now. China, totally different story, and I'm a little hesitant to speak about it because my reporting on the Chinese central bank is not sharp at all, but they clearly are not a subject of the Fed as much as like Taiwan would be or Brazil, but more of like a competitor, frankly, seeking to undermine the status of the US dollar as a global reserve currency, any opportunity they can get without tanking their own economy, which obviously, China got pulled along with our theory of easy money printing and stoking a real estate bubble, and they are really paying the price right now. So it's not like they're in some position of great strength with what you see happening in China, but I would describe their central bank as a wary competitor of ours looking to gain advantage whenever and wherever it can, but they're not in an incredibly strong position right now.
And one of the things that drove GDP to come in lower than expected was imports were higher than expected because of the strong dollar. But uniquely, when that's happened in the past, you've seen it with a spike in exports from China as well. But actually, this is like this unique time that we've seen where our imports are spiking and their exports are declining. And there's some conspiracy theorists that say, well, it's still somehow getting through Mexico, going to the US, but their export numbers are coming down. That shows you like how much we are now actually importing from the rest of the world. So as we silo ourselves, in almost like two different global economies, at some point that, continues to provide friction and a continued elevated inflation in some aspects of the economy. And I think that's why a lot of people think that like this 2% target is something that just can't be hit, right? And they're waiting for Powell to admit that maybe it should be 3% is the trailing rate versus 2%.
It should be 3. I think it should be 3. It's crazy him talking about 2%.
And Dan, what I think is so crazy is they have really painted themselves into a corner.
Yeah.
Because during 22 and 23, I mean, Powell was categorical, clear as day, 2%. It's going to be 2%. So they've staked their credibility to the point where if they said now, gosh, we've reevaluated, looking at the world, looking at all that stuff David was just talking about, we actually think 3% is the neutral number or whatever, where it needs to be, it would look like they were caving. It would look like they were caving to pressure from Wall Street to not keep rates too high for too long. And I don't know how they get out of that corner. I really don't.
But like you're talking about the economy being in a good place right now. And I think you're right. But we're clearly seeing a situation, both from a markets perspective as well as a cost of living perspective, where we've got a situation where there's the haves and the have-nots. And the have-nots are really struggling. And I mean, whether it's small caps, companies, or just individuals who are desperate to try and keep up with a very high cost of living and feeding their families.
Oh my gosh. I misspoken or spoken too quickly early. One of the biggest points I drive home through all my work, there is a huge difference between financial markets and the real economy. I mean, one of the points of the book is that what the Fed did doubled the value of the stock market in 10 years. They doubled the size of the corporate debt market. But when you look at these indicators of the real economy, wage growth was extremely anemic, productivity growth was really anemic, and overall GDP growth was anemic during the 2010s. And probably the species of headline that irritates me the most these days is, why don't people understand how good the economy is? And, we've got these headline numbers. Yeah, unemployment is below 4%. Inflation's coming down. The stock market is near record highs. That does not account for the reality of living as a wage earner in America at all. And it's not just because of inflation. I mean, we've had weak wage growth for 30 years. Yeah, the unemployment rate is low, but the nature of jobs is entirely different than it was back in the 1960s. The buying power of dollars has steadily declined. I in no way, shoot, as an investigative reporter, I kind of make my living talking about how rough things are for the middle class right now. And I in no way want to say things are good overall. And I think that the frustration out there is justified for most people. I do think, to restate, I got to be honest, I'm shocked at how sanguine and peaceful equity markets are. And, as you know, commercial real estate's a pretty rough area right now. I mean, there's a lot of pain in commercial real estate with commercial real estate bonds. But to have the Dow, scraping record highs constantly when we've had 5% interest rates for a year totally shocks me. And so in that way, I feel that Jay Powell has walked this tightrope and has amazingly gotten all the way to halfway through 2024 without a financial market crash. It's astounding.
He should be president. I'm telling you.
I don't even know what to say. Can you imagine that guy holding a rally, like holding a Trump rally? I don't know, man. I just hard to picture.
It would be a fun situation to see him up on the podium with Biden and Trump and debating economic policy.
I mean, poor guy, is what I would say to that. Imagining him on that stage, I don't know.
He'd be the only honest guy. Sorry, I'm getting off on a tangent. I hope I'm not backing you into a corner. Just like having some fun with the discussion that we're having right now.
Listen, I'm still a working reporter, so I've got to be incredibly circumspect in my comments about people who I have to keep calling, like, what can I say? I mean, Trump knows how to energize crowds and capture attention. Biden is not as fleet on his feet or whatever, but he's trying to push what he's done over the last 4 years. And I don't know, man. I mean, the spectacle of American politics doesn't seem to have room for a guy like Jay Powell, who is really methodical and low key and trying as hard as he can not to be inflammatory all the time. I don't know. That's why I'm stymied by the thought. Yeah.
What do you think, David? Are you going to vote for Powell? And
I doubt that Powell will want to actually become president. I think he's more interested in an autobiography and just like becoming a celebrity more than anything. My guess is he'll be hired by some hedge fund or investment bank, or there's like all these old stories of basically all the old Fed chairmen come in and they're supposed to add value to these hedge funds, giving them some insights on like a crazy day, on a crazy Fed day, as to like what some of these conversations are going on in the Fed's walls. And so my guess is like that's probably his biggest chance for a paycheck, is that, and an autobiography of how he killed inflation, right? So like I think that's the path he'll probably most likely take. Question is, what comes first, the hedge fund or the book?
Okay, I'll make a bet on that. I'll say it's the book, because don't forget, I mean, it bugs me. All these press reporters describe Powell as a lawyer. He was the first lawyer. That dude, he was a partner at Carlyle Group, one of the most famous private equity firms in America. And he was at Dillon Reed, then the Treasury, then Carlyle. And his fortune was worth ballpark 50 million when he walked in at the Fed. I mean, he's one of the richest Fed chairmen in history. So he's cool. Like, he doesn't need the hedge fund check, like Bernanke, who went to Citadel as a consultant afterwards. I think you nailed it on the legacy. I think Powell will do the autobiography. He'll go on TV. He'll get some kind of, maybe a hedge fund, but I could also see kind of he worked at a DC think tank as well. I think he's going for a place in history, and he's not going to be desperate for a paycheck right when he gets out.
I think he's also one of the few people who are acutely aware of how difficult it actually is to be the president of the United States, right? So I don't know if that's a job he wants to willingly walk into after how much transparency he might have on how difficult that job actually is to hold. So,
and I will say
I'm just speaking as a voter. Okay, he's not running for president. I realize that.
No, it's a great concept. I love it. The dude actually has a life. I mean, he plays guitar, he rides his bike, he's been spotted at Grateful Dead concerts. I mean, he's got something else to do when he gets out, I think. Yeah, and I think the grind of the White House can't be that attractive.
Chris, this has been a lot of fun. We've, gone a little bit all over the place. I apologize for that, but it's been a good discussion.
Totally.
Thanks for the time. We're basically, butting up against the end of the show. Any concluding thoughts? Talk a little bit further about, where people can get your book.
Where can we find you?
What are you working on next? Find out more about what you do.
Yeah. So I'll tell you what, I'm on the internet, ChristopherLeonard.biz is my website. You can get the books wherever fine books are sold, Lords of Easy Money. The point I really would like to leave with is I'm not like this Mr. Perpetual bear market guy, but I do think we are not out of the woods. I mean, things are great right now in equity markets, but you don't have 10 years of 0% rates and then jack it up to 5% in a year without some kind of large side effect. So I really do feel in monetary policy, we're in uncharted territory. And it's just going to be really interesting to see where things go over the next couple of years.
You're going to write a second book?
Not on this, man. Not on this. I've had my fill of Fed speak, so to speak.
We'd love to see a book on Gensler, by the way.
Oh,
you want to write one? Interesting,
man. Why would you bring that up at the very end? That's fascinating. What's interesting about Gensler?
Oh, we'll take that offline.
Okay. Well, hey, I'm in the market for a good story, definitely.
Oh, goodness gracious. Yeah, there would be a lot to be written on Gensler, just in the context of how he's managing the SEC. I could go on.
Yeah. Okay, that guy's
Chris. Yeah, we'll talk offline about that. This is awesome. Thanks very much. Be well.
Yeah, thank you guys. Great time. I appreciate it.
Thank you.
See you later.
Fantastic show. Thank you.